Hey everyone, welcome to this explainer. If you're trying to figure out what's actually happening in modern financial markets, you've definitely come to the right place. Today, I'm putting on my financial analyst hat, and we're going to cut straight through all that massive 2026 market hype. We're stripping away the marketing noise to look at the hard data on how artificial intelligence is actually impacting stock trading right now, and exactly how you should be positioning yourself.
Okay, so let's dive right into this. Because let's be honest, this is the ultimate fantasy, right? Every beginner trader dreams of finding that magic automated price prediction bot that just guarantees profits while they sleep. We constantly see those social media ads promising AI systems with these unbelievable win rates. But is it real? Can an algorithm truly forecast exactly where the S&P 500 or a specific tech stock is going to be next Tuesday?
Here's our agenda for today's masterclass. 1. The AI prediction myth. 2. Curing emotional trading. 3. The power of sentiment analysis. 4. Infrastructure versus language models. And finally, 5. Investing in the builders.
All right, kicking things off with Section 1, the AI prediction myth. This is the hard truth about algorithmic forecasting.
Look, the reality is that relying purely on machine learning to predict prices is, well, it's incredibly flawed. And trusting it blindly, that's a massive risk for your money. To really put that into perspective, just look at this staggering number. $1 trillion. According to research from the London School of Economics, that is exactly how much market value literally vanished in a matter of minutes during the 2010 flash crash. And the crazy part, this wasn't some major structural failure. It was just small data errors entering automated systems. Algorithms triggered each other in this massive cascading feedback loop, causing a terrifying drop. When automated bots operate purely on math without understanding human context, they can amplify volatility in a huge way.
So it all really boils down to what this quote is saying. Financial markets are messy. They're driven by millions of constantly moving parts, earnings surprises, geopolitics, global supply chains. A 2023 Journal of Finance study basically proved that even if a machine learning model actually finds a winning pattern in the data, the market adapts instantly. That profitable edge gets arbitraged away the absolute second other people catch on. So if a slick ad is selling you a bot with 70% accuracy, they are almost certainly just overfitting old data, meaning the bot is a total mathematical genius at predicting the past, but it's flying completely blind into the future. Moving on to Section 2, Curing Emotional Trading. Here is why human psychology is actually the real hurdle. So, you might be wondering, if AI can't perfectly predict prices, why on earth are hedge funds throwing billions of dollars at it? Well, because the biggest roadblock in trading isn't reading the charts, it's you. Just look at this comparison. As humans, we're totally wired for emotion. We panic and sell when the market suddenly drops, we get way too greedy during a bull run, and we revenge trade after a painful loss. An AI system, though, it runs strictly on logic, speed, and absolute consistency. It doesn't feel fear, it doesn't get cocky, and that is exactly why algorithms handle something like 60 to 70% of all trading volume today. The real edge isn't a magical crystal ball, it's just a complete lack of emotion. But here's the sweet spot for us as modern traders. AI processes data, sure, but humans, we actually understand meaning. Markets do crazy, irrational things based on cultural shifts, politics, or those wild black swan events that historical data simply cannot predict. An algorithm doesn't get that nuance. So the future isn't actually humans versus AI, it's humans plus AI.
Which brings us to Section 3, the power of sentiment analysis. These are the real tools the pros are using right now.
If the big players aren't using AI as a magic fortune teller, what are they actually doing with it in 2026? Well, they're using it to process massive amounts of information at lightning speed. And that leads us to sentiment analysis. This is the real, proven game changer in finance today. Modern language models can take a massive, dense press release or a rambling earnings call transcript and instantly score the tone. Think about it. While a human analyst might spend all day deeply reading 20 earnings reports, an AI can process 2,000 in that exact same time. It catches those tiny, subtle changes in a CEO's confidence or defensive hedging language that a human skimming the text would almost certainly miss. So these are the practical, everyday ways this is being used right now. Document analysis at a massive scale, spotting sentiment in the text, finding instant patterns across your whole portfolio the second news breaks, and crucially, filtering out the 95% of financial news that's just pure noise, so you only see the 5% that actually moves the needle. Basically, AI is an unbelievably fast research assistant, not a crystal ball.
All right, Section 4, Infrastructure versus language models. Let's take a macro look at the AI investment landscape.
We've talked a bit about using AI to trade, but how should you actually invest your own capital into this massive AI boom safely? To answer that, we have to look at the macro picture, because we're seeing a gigantic split right now. On one side, we've got infrastructure hardware, which is seeing a totally staggering 40% growth in capital spending as tech giants just frantically build out data centers. But then, over on the other side, you have enterprise AI software. Right now, only about 30% of the world's top 2,000 companies are actually ready to implement generative AI. The rest are kind of stuck in the mud, just trying to clean up and organize their internal data.
Now, what's really interesting about this slide is the sheer size of the gap we're seeing in the market right now in 2026. The semiconductor index, so the hardware side, is up nearly 48% year to date. Meanwhile, the software index is severely lagging, up just 7.8%. The market is actively rewarding the companies physically building the foundation of AI today, while Wall Street basically waits for actual enterprise software adoption to catch up. And honestly, that might not even happen until 2027 or 2028.
Just so we're absolutely clear on terms here, when we say infrastructure, we're talking about the physical stuff. The huge data centers, the intricate networking components, the ultra-complex memory chips you absolutely need to train and run these massive language models. In this AI gold rush, these companies are the ones selling the picks and the shovels. It's tangible, it's physical, and it is absolutely necessary.
And there's a really great quote from experts over at Stanford University who recently pointed out that the era of AI evangelism is giving way to evaluation. Basically, the speculative bubble of just slapping the letters AI onto a random software product, yeah, that's popping. Here in 2026, the focus has completely shifted to rigor, transparency, and actual utility. The market is completely over the hype. It wants to see a real return on investment.
Which sets us up perfectly for Section 5, Investing in the Builders. This is where the real money is flowing. So, if the software side is lagging behind expectations, where is the safe, grounded money actually going? Well, it's pouring into a market that's projected to hit a mind-blowing $3.5 trillion by 2033. The global AI infrastructure space is exploding from roughly $390 billion in 2025 straight to that $3.5 trillion mark. That's a compound annual growth rate of over 30%. Honestly, this massive physical build-out is arguably the single biggest driver of the Nasdaq today.
And if we look closer, the specific areas seeing just absolute explosive demand are high-performance bandwidth memory, known as DRAM, along with essential data center components, and the big, capital-intensive hardware providers. In fact, component costs are shooting up fast simply because there are actual, real-world shortages. You just literally cannot build these complex fabrication plants fast enough to satisfy the global demand. I mean, recent reports show the average selling price for data center DRAM jumping 20% in a single quarter. It's wild.
And nothing illustrates this result better than SanDisk. Look at this. After spinning off from Western Digital, their stock has rocketed an astonishing 526% this year alone in 2026. And remember, this isn't some flashy new chatbot company. This is a nuts and bolts company providing essential edge computing and data center storage. Infrastructure and memory stocks are totally dominating the market right now because they are grounded in tangible, real-world demand.
Okay, let's wrap this up with some tailored advice for beginners. This is your 2026 action plan.
Based on everything we've talked about today, here's your game plan broken down into 3 actionable steps. First, use AI tools to filter your information, but never to make your final buy or sell decisions. Let the AI handle the boring, repetitive stuff like reading earnings reports and scanning news sentiment. Second, keep the actual investment thinking human. That means you are still in charge of managing your own risk tolerance, deciding your position size, and keeping your emotional discipline in check. And third, always verify AI outputs with primary sources. AI can hallucinate and makes weird mistakes on edge cases, so treat whatever it gives you as a really powerful starting point, never an absolute conclusion.
So, I'm going to leave you with one final thought as you evaluate your own portfolio. Knowing that algorithmic systems now control up to 70% of all market trades today, what's your play? Are you going to gamble your hard-earned capital trying to find a magic bot to predict the software hype, or are you going to safely invest in the physical hardware that is actually powering this entire new reality? The choice is totally yours. Thanks so much for joining me on this explainer, and as always, keep learning.